What a great array of panelists we have. Welcome, of course, to the Qatar Economic Forum. Henry Fernandez of MSCI Inc., the chief executive there, one of course, the key providers of indexes. Larry Fink, BlackRock, of course, largest asset manager. Bill Winters, CEO of Standard Chartered, an emerging market-focused bank. It is wonderful to be here with all of you, gentlemen. And I feel like 2020 was clearly the year we understood what investing with purpose meant. We've all heard and understand what a social crisis has been, what it's meant, what a climate crisis is, and what it means. But we want to now push this conversation forward, guys. We want to understand not only what you've been thinking from the annual letter that you put out back in 2020, Larry, Henry, the thought leadership you've got in terms of the role of capital markets, Bill, the work you're doing with the voluntary carbon offset market. You're all playing your roles. But Henry, what more about measurement do we need to see? The SEC looking at proposing new roles on ESG disclosure. How do we know you're already making an impact in the capital markets?
Well, thank you for having us here, Caroline, and it's a pleasure to be in this panel with Larry and Bill. I guess measurement, not enough yet at this point. There is quite a lot that still needs to happen in terms of the disclosure by companies about ESG in general, but also particularly climate change. We estimate that only about a third of the companies in the MSCI All Country World Index, which is about 9,000 companies and 98% market cap, 50 countries in the world, and only about a third of them, are reporting, for example, net zero pledges. We still have a long way to go, but we believe that there will be an acceleration of this, particularly this year, coming out of COP26 and all the focus of the U.S. administration and the rest of the world. And we better start doing it because with respect to climate change, there is a major reconstruction of the entire global economy away from fossil fuels into renewable energy that needs to happen in the next 10, 20 years. Some people think it's 30 years to 2050, and that's not going to be that long to achieve this. And there is a repricing of assets that is already happening and is going to accelerate, and a reallocation of capital. So the measurement tools need to be there to be able to provide and facilitate that process of reallocation of assets and repricing of assets for investors and for companies to understand the trajectory they're under in terms of net zero goals in their operations.
Larry, that fundamental reshaping of finance is one that you sort of spearheaded in that annual letter that you wrote, not of this year, but of 2020. But we now sort of feel as though everyone is smelling greenwashing everywhere. Everyone's worried about whether or not really, truly the ETF they're getting into has the right companies within it that are ticking the E, the S, the G that it seems to be providing. How do you hold yourself accountable to that?
Well, it doesn't matter whether I agree or disagree, but I think the capital markets are moving faster than most of society. We are seeing more demand for sustainable strategies. More investors worldwide believe climate risk is investment risk. More investors around the world are asking, how do we determine the path towards decarbonization and how each company is performing in that path? And I think from the ExxonMobil vote, we are seeing vast change very rapidly. The issue is not whether somebody thinks the composition of an ETF or any portfolio is right or wrong. We could go into a long debate on that. But we are not going to get to a net zero world if we're just asking public companies to move forward. Public companies are moving more rapidly than most governments, moving more rapidly than most society. If we really want to get to a net zero world, it has to be all of society working together. We cannot focus on divestiture from public companies. That is not a good outcome because we want to be transparent and see how companies are moving towards their entire transition and how they are performing in this transition. We need governments working with the private sector. We need investments to complete the decarbonization. You frame the question, and other questions are around maybe electricity and cars and all that. We're going to get there because we have moved the power grid to now being having zero green premium. But that took 30 years to get to wind and solar to be equivalent of coal. Obviously, we have issues related to the persistence of power because of wind and solar, so we need backups. But I don't hear enough about creating green cement and green agriculture and green hydrogen and steel. We're focusing on one segment of the economy, and we need to be focused on everything. But just getting to your question related to the composition of a portfolio. More and more sustainable strategies still have to be tethered towards a liability, the MSCI index or a S&P or any other liability. And what MSCI and what BlackRock has been creating are composition portfolios that are democratizing what people want. It doesn't mean it's 100% in a decarbonized portfolio, but what it means is we are picking the company in each industry that is moving faster in a decarbonized path. So it may mean we own a hydrocarbon company or a company that's making hydrogen, but our scores are better. Now, some people may call that greenwashing because we may own a hydrocarbon company. This is not a black and white world. We have to evolve and move, and we are working with pension funds. And in the United States, we have to make sure that we quantify that investment risk, that climate risk is investment risk. We can't do it because we believe in climate change alone. We're not permitted under the law of the United States to doing that. So we have to have quantifiable data. And this is why with what MSCI is doing, what BlackRock is doing with Aladdin Climate, we are developing the analytics and data so we can justify these investments. And through that justification and through more disclosure, because when the SEC asks for more TCFD disclosure, as Europe asks for more TCFD disclosure, we're going to have ability to analyze and design portfolios that democratizing more investment. So I'm absolutely convinced the tectonic shift towards investing in sustainability, it's happening. But that does not change the world. It changes the world only partially. And we need to be more focused on how we move the entire society forward, not just public companies.
Interesting. So you want public help, government help within the public companies and also private companies. But Bill, I mean, you sit here as, well, I think I just checked who your key shareholders are, and BlackRock is, of course, one of them when it comes to Standard Chartered. You've aimed to be the most sustainable bank out there. But how do you hold your measurements to account? You're looking at, Larry was just mentioning how it has to be more steel, more supply chain focus. How do you look at your supply chain as a whole to make sure that your bank is the most sustainable?
This is a huge challenge, and the way that it works, what we said is that, like many companies, as Henry mentioned, we've committed to transitioning to net zero by 2050, and getting there much sooner in terms of our own operations. But over 95% of our emissions are emissions that we're taking responsibility for on behalf of our clients. So it's the steel manufacturers and the airlines and the shipping companies, fossil fuel producers around the world. And there is no agreed taxonomy for the allocation of those emissions responsibilities today. Being able to state clearly what is our baseline, so we're going to go to zero from what, is a matter of quite a bit of work that we're doing right now. We've committed to do that work between now and October or November, something like that. We'll publish our results. It won't be perfect because the data that we have access to from many of our clients, keeping in mind that Standard Chartered Bank is a bank that disproportionately serves developing countries in Asia, Africa, and the Middle East. And the quality of the data in those markets, in many cases, is nowhere near as robust as what we would have in Europe or the US, or for that matter, China or Japan. And so we're going to have to use proxies. We're going to have to use some approximations, but we'll publish it. And then we'll commit to get that down to net zero, largely through working with our clients to affect their own transitions. Most of our clients we've already engaged, and they are very actively working on their net zero transition plans. We've done some really interesting research that makes it clear that for multinational corporations, roughly 75% on average of any MNC's emissions are coming from their own supply chain. So much the same way as our emissions are coming from our clients to whom we provide financing. For the MNCs, is coming from their supply chain. 80% of those suppliers are in countries that have less robust data frameworks than what we have in the US or Europe. So there's a huge underlying challenge. There's also an enormous financing gap. So these companies, in particular in less developed countries, only have access to about 10% of the transition financing that they're going to need. 90% has to be found. Of course, there's an opportunity there for a bank like Standard Chartered to help out. There's also a big gap that society will face. And it's clearly a gap that governments, the private sector, the public sector, multilaterals, export credit agencies, we're all going to have to work together to close that financing gap. And that's our undertaking. That is our approach. And we're full speed ahead on that.
Both you, Bill, and Larry have talked about government's role within this. And Henry, you put out, a very forceful viewpoint on the role of capital markets within the net zero revolution. It's interesting. Some are sort of saying that maybe the capital markets role, the investment opportunity within ESG is in some way almost a placebo effect. It's stopping the government change that is necessary. Do you agree with that in any way?
No, not at all. I think I concur completely with Larry's view, which is all of society, households, municipalities, educational institutions, private companies, public companies. All of society has to contribute to this net zero world that we need to achieve. Just as an example, publicly traded companies, as represented in the MSCI All Country World Index, the 9,000 companies that I mentioned, represent 22% of the total emissions, carbon emissions currently. That's about 11.2 billion metric tons of CO2 equivalent, and that's compared to the 50 plus billions of metric tons that the world emits. So that tells you that there is another 78% that needs to be addressed. So all of society has to go. And the role of government, I think government have begun to get together and push this, but I think the capital markets are beginning to move faster. One thing that is beginning to dawn on us at MSCI is that this reallocation and repricing of assets is going to be front loaded. It's going to happen, it's already happening, and it will accelerate in the next few years. A lot of people think that this repricing and reallocation of assets is going to be back-ended towards the end of 10 years or 15 or 20 or 30 years. It's going to happen faster than most people think. So if anybody is running a company today, if anybody is running a portfolio today, they have to move fast, because otherwise this is going to have a significant effect in their portfolios. And if we begin to eliminate or disengage from the companies that are carbonized in the world, the universe of investment opportunity is going to be very limited. And the portfolios are going to be highly concentrated. And that's not going to be good for the capital markets either. So therefore, we all have to work together. There have to be a significant amount of engagement with companies to push them and encourage them and persuade them to decarbonize world, both private and public. I think all of us have to encourage our own governments to go on this trajectory. All of us individually in our own homes, in our own households, need to install solar panels and things like that. It have to be a major effort. This is a Herculean task that has not happened in the history of the world, particularly in a very short period of time. And there is no alternative. There is no planet B that we can go to at this point.
Well, you can dispute that with Elon Musk, maybe. But meanwhile, I'm interested, Larry, in the pushing, the persuading. You referenced it earlier, ExxonMobil. That was a dramatic change. A small hedge fund, Engine One, able to change up the board of Exxon, but not without your support. I'm interested in why perhaps you didn't lead the charge, why it took an Engine One to do that.
We're a fiduciary. Asset managers are at the nexus between the asset owners. It's not our money, and the companies we manage. We've had great dialogue, continuous dialogue with companies such as Exxon. In the past, we voted against different propositions within Exxon, We're thrilled about how this is moving forward. This is the tectonic shift that's happening. It doesn't have to be large companies. It's a movement. It's not one company. It's not BlackRock. It's a movement. And so I don't look at this as anything unusual or disproportionate. I love the system that everybody has a vote. And it doesn't matter if you're large or small, if you have a persuasive argument as an activist, and this is what this company did, and they provided a great slate of potential board members. And so our corporate stewardship team had the ability to make a judgment whether the current board or the composition of the board would be improved with this slate of board members. And the results are the results. But let's be clear, you're focusing on one company. There are thousands of companies that we are engaged with every year. There are thousands of votes every year. I think this year there was 250 climate-related proxy votes out of thousands, 10,000-ish public companies. The focus should not be on one or two companies. Now, obviously, that was a highlighted company. But our approach, having the largest corporate stewardship team in the world, is to be engaged with companies. We don't want to go to a corporate vote. We want to have companies moving forward through engagement, that we can agree with management and a board. And I would tell you, we made substantial changes with so many companies that we voted with, not against. And it's because they have been moving forward. They have taken an active participation in focusing on how they're moving forward in a decarbonization process or a net zero company. So whether it is on sustainability or governance or social issues, we are engaged. And I'm very proud of the position that we have taken, whether it is our engagement with MSCI as a company or our engagement with Standard Chartered as a company. Our team is engaged all the time. We have meetings with companies continuously. It's not about having a binary decision of yes or no during a proxy. And unfortunately, media focuses on that binary moment of 250 proxies where there is this binary decision on sustainability. If we want to get to a net zero, it's about the other, 9,750 companies. It's about engaging with them throughout and moving them. And that's the course, how we're going to change things, not one vote. I know it's nice and big, and we can talk about it on the media, but it's the things that are not being watched or seen. It is the engagement that we're doing persistently throughout the year. And that's our commitment to our asset owners, that we are going to be engaged with their money on trying to moving companies forward.
What about engaging with governments, Larry? What about when you're looking at China in particular, and there's this automatic friction that we think of when we think of China when it comes to the S and the G, the human rights element, but you sort of really clearly feel that it's better to have a seat at the table than not at all. How are you guiding when you're looking at making more inroads into China with BlackRock?
We're very engaged in China. We're the only international firm that have both licenses. We have written corporate stewardship positions on human rights. We are focusing on judging companies. We don't judge governments. We try to be non-political in the United States and in every other country. But we believe in engagement. We believe in connectivity. We believe as more countries, as more of economic activity is part of the global capital markets, in our opinion, and I'm sure in Bloomberg's opinion, because you participate this as a company, the more we have more involvement in global capital markets, the better we have engagement and better outcomes occur. So we're a big believer in engagement. We want more and more companies and countries to be engaged in the global capital markets. The capital markets are the ultimate judge, and so we believe we're playing a very big role. Our role in China is not about the political side. China has a very big need in retirement. No different in America. They have a great need in retirement. And we believe we'll have a role in helping Chinese build sufficient savings in retirement so they could live in dignity during retirement. And so our ability to try to build societies, it's consistent. When I talk about stakeholder capitalism, I talk about being a part of each society where you operate. And I could assure you at BlackRock and how we judge Chinese companies who are public, we judge them on their human rights activities no different than I judge European companies or American companies. And so we believe as more Chinese companies are engaged and more Chinese companies go public, whether it's on the Hong Kong exchange or the Shanghai exchange or the New York or London, we are going to be engaged with them with the same judgments on E, S, and G. And we believe that's a powerful role that we can play way beyond the politic of the world.
And a role that, Bill, you know well, as one of the oldest foreign banks within China, aiming for sustainability, your role within the emerging markets in general, like how are you finding these conversations are going? How little is understood in terms of the transition that they're making? You were talking about it a little bit earlier.
I think both Henry and Larry have referred to the pace at which I would say the sentiment and the reality are moving. And the fact is it's moving very, very fast. The number of places for any government or corporation to hide when it comes to affecting their own net zero transition, that space is shrinking very quickly. So companies or countries that thought that they could escape this by just putting their head down and letting somebody else take it first, they're finding that their access to finance, their access to capital markets, their access to customers for these smaller companies that are feeding into global supply chains, they're drying up, and they're drying up quickly. So in the research that we've done, 85% of MNCs intend to differentiate between their suppliers in developing countries who have a clear, credible path to sustainability versus those that don't. 15% have already exited suppliers that they recognize aren't making the efforts that are necessary in their opinions. That's only going to accelerate. So when we have discussions now in the least developed countries, but also in very developed countries, but that are outside of the US or Europe, is a very high level of engagement. I mean, China is launching its own carbon market. It has carbon exchanges at a provincial level today, rolling those up into a nationwide exchange that I think, if done successfully, and I know that's their intention, will rival the efficiency of the European market, which is, for the time being, best in class. And they're very keen to hear from the task force work, this task force on scaling voluntary carbon markets, how the government-backed compliance markets can interact with a voluntary carbon market, where we're trying to set very high standards as well. So I think there's a relatively recent but very substantial focus on the sustainability question in even the least developed of countries today.
That voluntary carbon offset market that you're digging into, Bill, how soon do you think it's a reality in the US?
So it exists today. I mean, there is a voluntary carbon market today, but it's very fragmented, and it's I would say it's an uneven credibility. So you made a reference in an earlier question to Larry about greenwashing. There was a sense that the carbon offset market was used for greenwashing. Our objective is to set a single standard that effectively is a global standard. That's a very, very high standard, where no one will question the credibility of the underlying contracts if they're complying with these principles that we set up. And we're recommending the creation of a governance body that would also be global in nature, that would maintain these principles, because they will change over time as science changes and as understandings change. So to curate these principles and continue to fine-tune the market. It's not a matter of this being US or European or Chinese. This is for the world. We've got 400 members of this task force, 250 corporations. Both MSCI and BlackRock have been very substantial contributors to that effort, along with a broad range of investors, of emitters, of banks, NGOs, academics. And the one thing we all have in common is a view that if we have a really good, robust voluntary market, one, will have better transparency about what the price of carbon is, which we can all use in our capital allocation decisions. Two is we'll have a facility to channel eventually hundreds of billions of dollars from the pockets of people like the Standard Chartered Bank or individual consumers into the hands of people that can actually get carbon out of the environment. That's the prize. We've got a consultation paper that actually closed. We took our last comments yesterday. We'll produce on July 8th, and I think the market will be up and running from then.
We'll look out for it on July 8th. Henry, I was just doing a quick last-minute search on Bloomberg News about the latest things you guys have been saying and thinking about and innovating. And, oh, well, look, what caught my attention as a member of the media was, of course, the fact that potentially you're looking at crypto indices. But I'm interested in how you have to think so well-roundedly about ESG and every new innovation that you have, because at the moment everyone's talking about or perhaps Bitcoin mining not being good for the environment? How do you think about it in the decision making and the innovations that you make on the platform?
Yeah, so that's a classic example that everything we look at MSCI, we try to put a climate change filter on it. Climate change is really permeating every aspect of what we do at MSCI, from the recommendation of policy benchmarks to asset owners, to the creation of indices for investment products. We're putting climate change in our risk models for portfolio risk as part of some of the other factors that affect return and risk in portfolios. And cryptocurrency is not different. We're looking at 2 or 3 different ways to look at cryptocurrency. Clearly, a cryptocurrency index itself, but secondly, the climate change implications of cryptocurrencies and what does that mean for society and reducing emissions. We're also looking at cryptocurrencies in the context of the blockchain, particularly the effect that will have on industries and companies in various sectors. So it's pretty wide ranging. One thing that I will add, going back to the question of emerging markets and China, in many of the emerging markets, we have had a number of sessions, especially in China, with the Securities Commission and with many corporate companies or corporate sector organizations and associations, describing kind of step by step all the elements associated with the E and the S and the G, and why many companies in their countries need to embrace this new world of an integrated world, taking into account institutional governance and protection of the environment, and obviously encouragement of their very different human capital and social issues. So the Securities Commission in all these places, especially in China, has been pushing us pretty hard to publicize a lot of this, to make sure that we are open and transparent, and that's going to help the capital markets of the country. So I will concur wholeheartedly with Bill in what he's saying about the movement there, and what Larry was saying about China and their role in climate change and in ESG. It's happening. Now it's happening, from behind, but it is happening.
Larry, is this something you're thinking about when you're looking at companies putting their balance sheet to work in Bitcoin, about the ESG impact?
I don't see any companies putting their capital into Bitcoin, so I don't know the form of the question. I don't know of any companies that are putting their balance sheet in cryptocurrency. I can tell you, long-term investors are very unfocused on the tick-tock of the market, the tick-tock of the ups and downs of crypto. I think it's fascinating to watch crypto because it's inspiring a lot of young investors. I think that's fantastic. I think if that inspiration leads to long-term investing, that is a great outcome. But with our focus on long-term investing, and with 2/3 of the assets we manage are for pension funds, the conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. But right now, the bid-ask spread, the volatility, it has not led to widespread conversations worldwide. Where conversations I have with governments and leaders is about, should there be a digital currency, true digital governmental currency that will change finance in a very substantial way. If there was a digital dollar, a true digital yuan, that will change that would be much more impactful than any other, like a crypto. But it's something that we look at, some of our investors use as one tool for investing. But it is, it is really about the tick-tock of the market, and that's what public media does. You focus on the moment, the markets, and the ups and downs. BlackRock is focused on the long-term, building long-term portfolios as a fiduciary for our clients. And if we deem crypto or any asset in the world is a great long-term asset on behalf of pensioners worldwide or people building pension funds, then it'll be one of the tools for asset composition. But the tick-tock of the market, the ups and downs of what's going on in any one individual stock or a crypto, it's really unimportant.